With the U.S. election season in high gear, control of the presidency and Congress hang in the balance. We believe the outcomes of the races will have a nuanced impact on investors. Which factors will potentially affect portfolios? Watch MarketScape to get our take. We'll start with Vice President Kamala Harris and former President Donald Trump's stance on economically important issues such as taxes, tariffs, regulation, climate change, and immigration. On many of these issues, there's a lot of daylight between the candidates. While we believe their positions are likely to impact multiple sectors, such as energy, financials, and healthcare, history has shown that political control is not a robust indicator for sector returns. Instead, returns are ultimately driven by fundamentals, and what's more, it's impossible to know which policies will be enacted, or if unexpected factors might alter their trajectory. The stock market has done well under both parties, and when we look at both the president and composition of Congress, there is something positive that each party can point to regarding results. But the sample sizes are small, and there are a number of other drivers of return at play, so we hesitate to suggest using this as a forecasting tool. Rather, market movement is determined by a complex interplay of the economy, corporate fundamentals, and valuations. While there is a relationship between policy and these variables, it can be difficult to attribute the effect when looking at market performance. The expected impact from policy initiatives does not necessarily translate into returns. This highlights the challenges of investing tactically. Given the high level of passion around the upcoming elections, it's natural to think of the potential outcomes as binary, either good or bad. In reality, though, the result is much more nuanced. Investors can take comfort from the fact that strong stock market outcomes have historically transcended who is in office. Amidst all the political drama, investors should not lose sight of the fundamental drivers of market returns. Instead, they can prepare for different economic scenarios while staying historically aware. In short, we favor preparation over prediction.